This is the lecture on the remaining slides for Chapter 19 that I didn't finish in class. There could be a multiple choice question or two on these topics, probably only one, so just a quick listen. So on the balance sheet, you're going to see three different inventory accounts. You would see one for raw materials inventory. You'll see one for work in process inventory and one for finished goods inventory. So the finished goods inventory is comparable to the inventory account that we saw when we had retail merchandisers. This is where the items that are available to be sold will be sitting. So items will move from finished goods inventory to cost of goods sold. So the items that are sold are moved out of this account into the expense account, cost of goods sold. So merchandising, you have just that inventory account. Manufacturing company, you'll have inventory, and then underneath of it you have the three accounts. So those three accounts added together give you the balance for inventory, and they are still a current asset. The value chain, so the value chain is a concept of how a company generates value or creates value. So there's different ways that you can create value within or increase the value that's created by the company. So one concept is just-in-time inventory methods. So just-in-time, or JIT, the idea is that you create value in the company by keeping the lowest amount of inventory on hand as you can, because having inventory increases costs of the business, because to have inventory you have to have paid for the goods, and that requires or increases your financing costs because you have to have paid for that inventory, meaning capital is sunk into the inventory, and that capital could have been used to purchase other items that are giving you a better return, or a return from something else. So if you use a just-in-time inventory system, it means your supply chain is developed so that when an order comes in, you immediately have an interface with your supplier so that the order for the raw materials goes out when the order for your product comes in, and the raw materials arrive just in time to produce the product that is sold. So you don't have raw materials sitting in your warehouse. The raw materials come in the door just in time to produce the product that has been sold. So Dell was one of the first companies that was really good at using this. So they didn't have their circuit boards or their computer cases sitting around in their warehouse. They actually didn't order the components for the PCs until the PC was ordered. So as soon as an order was placed with Dell, the order was placed with their suppliers for the parts of the PC to come into the factory, and they were then immediately produced on the line when the raw materials arrived at the factory, and the production happened when the computer was ordered. So they had no cost of storage of raw materials, and they had no theft of parts because there weren't any parts being stored. So that really lowered the cost of the inventory because there was nothing sitting around in the warehouse that could be stolen or could be broken, and there was no cost of storing that raw materials inventory. So they actually were selling and collecting for the sales prior to even paying for the products that are being used to manufacture the inventory in the first place. So they had like a negative return because they were collecting for the revenue before they were even paying for the inventory item or the parts that went into producing the inventory item they were selling. Total quality management is a concept where you are reducing the defects in the finished products with the goal of having zero defects. So what you're trying to do is at each step in the production process or the manufacturing process, you've got controls in it so that there are no mistakes at all in the manufacturing process. And because of that, you have no scrap or nothing being thrown out. So each step is being done with high precision. And because you have high precision, there's no waste, and nothing is being destroyed at the end. So you don't have any waste at the end of the production process. And so there's always this trade-off between running things through quickly. But if you run things through quickly, then you're going to have some miscalibration in the machinery or some things that you might not have good inputs, and then you end up having a certain number or a certain percentage of the product that's not usable when it gets to the end of the process. So there's this trade-off. Theory of constraints. So constraints are bottlenecks in the company's potential manufacturing line, so their potential for profitability. So this is where you focus on the production system or the manufacturing system, and you try to figure out where the bottleneck is. So you try to identify, well, if we're running at full speed or we're trying to run at full speed, where do things get bogged down? Where is the problem places that is going to hold things up? So if we need to have a huge order or we're suddenly overwhelmed, where are things going to get tied up? What's going to slow us down? And then you try to figure out how to manage around those constraints, or what can we do to make it so those constraints aren't slowing us down. And then there's enterprise resource planning, ERP, and this is a big, this is sort of one of the bigger things now, and this is a software program that's designed to manage all the major business processes. So it's a software system that all of the different aspects of the business are connected within one software. So it's not just accounting has one software, and finances have one software, and purchasing has one software, and marketing has a different software. They're saying that they have a software that connects all of the different parts of the company together. So you have marketing linked to accounting, linked to management and the planning of manufacturing, all together in one system. So everybody's looking at the same information. So human resources is linked up to marketing. And then we have activity-based costing. So we've kind of talked about this because when we're doing the predetermined overhead rate, that's using sometimes activity-based costing. So it's allocating the overhead based on some activity that's taking place within the factory or the production process. A balanced scorecard. This is a management method of evaluating the management or the employees. And what they're doing is they're trying to do the evaluation in an integrated fashion. So they're looking at both financial measures and non-financial measures. So they're trying to link the performance with the overall company objectives. So an example of this would be looking at customer satisfaction in addition to earnings per share. So they're going to look at some financial measures and they're going to look at some non-financial measures. Business ethics. Employees are always expected to act ethically. Many organizations now have a code of business ethics, and it goes in and out of focus as you see economic scandals happening. So, after we had Enron and Global Crossing and WorldCom and the early 2000s where Sarbanes-Oxley came in, we saw a lot of focus on it, and then it kind of fell off a little bit. And then in 2007, where we had the other big market crash, we saw a fall off. Well, we saw starting to fall off, and then we see another big, huge focus on business ethics again. And now we're starting to see a back off on those things again, and they're trying to roll back Sarbanes-Oxley again, and they're trying to roll back the regulation of the banks again. And so you sort of see this as cyclical, because they put regulations in, and then the businesses don't want the regulations because it's keeping them from doing more business. So, but it should always be in place. A big thing about business is you have to figure out how to incentivize the business people so that they are, sorry about that, so that they are doing the work that you want them to do. That is a big issue. The controls that you put in place have to be effective and realistic, so that's definitely important. Sarbanes-Oxley was put in place by Congress in response to a lot of the ethical issues that came up around the scandals in the late 1990s, early 2000s. It did clarify management's responsibilities. It requires the CEOs and CFOs to certify the financial statements. And it substantially increased penalties for misconduct, and it made CEOs and CFOs directly responsible for misstatement of financial statements. So that has changed attitudes of the top management significantly. Before that, it was very, very difficult to hold upper level management responsible for white collar crime. So it's made a big difference in a lot of ways. Corporate social responsibility, it's becoming more standard. For a long time, we didn't really know how to measure this, and there is now a way to audit for corporate social responsibility. So it's a company's effort to employ sustainable business practices with regards to employees, society, and the environment. One thing that they've referred to as the triple bottom line. More than 50% of the 500 largest companies provide sustainability reports. And as I said, the CPA, or American Accounting Association, has now released a set of standards to use to audit these sustainability reports. So it's now actually a formal thing that's out there. Okay.